All right, looking good. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is Wednesday, 8 p.m., February 2nd, 2022. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. So we will definitely dive into some crypto, dive into some stocks, take a look at the DXY, a couple commodities, see what's going on here. Obviously, we have big earnings coming in, and sorry, I'm a little stuffed up today too, guys. After the good earnings on Google, I think people were a little too optimistically ambitious, so to speak, as we just saw Meta take a big plunge, 20+% on that less than ambitious earnings call. Basically the exact same thing that happened with Netflix. Numbers not that bad, look okay on paper, and then you start hearing their like overall tone and essentially like their forecast for the next quarter, and it's absolutely atrocious. So they have, let's be real. There's no surprise here. We know that essentially last quarter was the top. It was the top for everything. There's a couple companies that will probably still do well. Arguably things like Google, maybe a couple other ones, but it's obviously the top, and that's part of where I go with the inflation argument too. It's a funny thing. People that flip the script and change their mind about things all the time, you will notice that those people oftentimes will be, well, of course they'll be right some of the time because they flip back and forth, and usually there's only two options, either up or down, bullish or bearish. So they're bullish when they should be bearish, and they're bearish when they should be bullish, or vice versa. So you'll notice like when crypto was at 70,000, everybody was super bullish, but that was the time to be bearish. When, we were coming up on the end of the year, and a lot of these stocks were topping out, or way early in the year where the tech stocks were topping out, we were already basically on top of it. And then, of course, we're talking about be careful, get out, things are going to crash. We got to protect ourselves, preserve principal, protect capital. Everybody else is the most bullish. Buy the dip, buy the dip, buy the dip. And then, 9 months later, you guys remember me talking about ARK, Kathy Wood, in, I can't even remember when it was. It was like March or something like that. It was so early in the year, and I was like, let's revisit this conversation a year from now. She had a good year, but let's see what really happens. This thing is topping out. It's going to implode. It's going to lose so much of its value. This is all trash stocks. She's talking about this isn't a bubble. We're not in a bubble. If we were in a bubble, I would be getting rewarded for what I was doing. And I'm like, oh, you just don't see it because you're inside the bubble. You're blinded by the bubble because you're in it. If her getting rewarded is not like billions of dollars flowing into her fund that no one had heard of 2 years before, if that's not being rewarded by irrational market participants, I don't know what is. So, we'll often see that these people that have been, just watch over the next couple months, depending what happens with these markets, with crypto, with stocks, with everything, real estate, watch how many people that you thought knew what they were talking about all of a sudden are going to get exposed as complete frauds, either because they're flip-flopping nonstop and constantly just getting chopped up and wrong, or whether they're just trying to just stick with the forever bullish or forever bearish call, because that doesn't work. You have to deal with what the market gives you, and you have to adapt. You have to, because when the market switches, you have to switch too. So all the people that have been bearish for months or years or decades, all right, bro, please don't spam the chat, man. It's distracting. All the people that have been bearish for literally decades are going to come out talking about, see, I told you so. I knew it. The crash is here. This is the big one. The same way that all the people that are like super bullish will be talking about, oh, I told you we were bullish. We were bullish the whole time. We stay bullish. We're forever bullish. Those people will always be wrong eventually. The key is to be able to adapt with the trend. That's the most important thing. To be able to see what the trend is doing, to see what the markets are doing, and then go with it. That's the most important thing. So that's why last time we spent basically the whole stream talking about trend and why that was so important and how to identify when the trend is switching. Because we don't want to be that person. We don't want to be, see here, and this is why I brought up Cathie Wood. Cathie Wood was nobody for a long time. And then all of a sudden, she outperformed the market with a really heavy concentrated bet on Tesla and Bitcoin, which was obviously a good bet. It was a great bet. But the problem is that once all that speculative tech and the bubble had popped, she couldn't recognize that the bubble had popped. So she was selling things like Apple stock and selling things like Tesla and then doubling down on like her trash, like non-profitable companies that are now, many of them down 75+%, buying the dip, quote unquote. But she couldn't realize, she couldn't see, like many people, I'm just using her as an example because she's the easiest example, because she made a fool out of herself now. You know, billions of dollars flowed into her fund, and then she's just cutting it by 20%, 30%, now down 50%. Her entire fund is down 50%. Anybody that bought into that for over a year now is down massively. And that's my point, is she couldn't recognize that the market had shifted. Things had changed. She should have been pulling back on these speculative trash bets. And instead she was just doubling and tripling, quadrupling down. And then she just says, oh, well, we have a 5-year time horizon. Sure, but you can't lose all the money while you're waiting for 5 years. Like and I'm not even against what Cathie Wood was getting at. I believe that she's right long term about a lot of those trends and directions and all that stuff. But she bought things, let's say, at 100% of their valuation, and now they're at 25% of their valuation. So who's the smart person? Her for doubling down the whole way down, or like us for sitting on the sideline and then saying, oh, I think I'll swoop this up for 75% off, 80% off, 90% off. That's the difference. Like, I like her narrative. She's right about a couple things, but she's just too early. And you know the old saying goes, you could be right, but if you're early, you're still wrong. And the same way about if you're late. You could be right, but if you're late, you're still wrong. And, you know, that's, I guess, the intro for today. So, you know, we had another stock just completely fall out of bed. And we know this whole entire market has been held up. The main indexes have been held up for the last, 9 months now by basically the FANG stocks. And if you're not familiar with the term FANG, it's Facebook, Apple, Amazon, Netflix, and Google. Netflix has gone sideways forever, and then finally had a little pop up based on Squid Games, and then just had a 20% like gap down, like, crash. That's an instant bear market based on Wall Street, determining a bear market. 20% drop, bear market. So it went from all-time highs to a bear market in after-hour trading, extended hour trading. I mean, that's wild. And then now we see, so we had Netflix, and, it was based on basically not even bad numbers, but it was based on the adjustment of their future forecast, saying like, hey, we did okay last quarter, but like from here on out, things are going to suck. Same thing happened with Facebook. I mean, if we can glance at Facebook just right now, just as an example, and then we'll, kind of go in our regular order. I didn't even pull up Facebook. Well, I have PayPal right here. So we'll look at PayPal. So PayPal didn't even like have some crazy, like horrible miss or anything. I mean, let's look at their earnings. Earnings and revenue. Estimate was 112. Reported was 111. $1.11. Estimate was $1.12. They missed by a penny. 0.95%. So that's nothing. And then reported revenue was $6.918 billion, and the estimate was $6.898 billion. So that was a beat by 20 million, which is 0.33%. It's nothing. But they basically were right on target. They missed earnings by a penny. Revenue was up by 20 million, what they expected. So it's basically right in line. So why did this thing completely fall out of bed? Well, it's because of the way, basically what they said. They said like, hey, look, you know, and 25% gap down. 25%, you know, it was, I mean, from their close to their open, from the gap down was over 20%. And then where they closed out today was over 25% down. So a quarter of their valuation gone in a snap of a finger. Based on what they said, they're changing their future outlook. So why are these companies, you know, PayPal obviously not as big as Facebook, Apple, Amazon, all these ones, but why are they all of a sudden shifting? What do these people that run these mainline businesses, you know, payment processors, main tech stocks, you know, advertisers, revenue, onboarding users, you know, building up all these, you know, networks and all this different stuff, all these like little keywords and niches and all these things that get everybody excited about the future. What are they seeing that normal people don't see? They're seeing the same thing that we see, that we peaked. The future has peaked. The economy has peaked. GDP has peaked. Growth has peaked. You know, spending, earning, revenue peaked. So let me jump over here and okay. So I guess I'll talk real quick about like pre and post market trading and what that's all about. Because I know someone had asked specifically about it in the group. So it's basically, it used to be referred to as ETH, which is just, it's extended hours, extended trading hours, or EHT, you might hear it called sometimes, extended hours for trading. But it's basically like pre and post market trading that takes place. But you can't have, there's no like market orders, buys and sells. You can only put in like match orders basically. So essentially it just allows people to trade directly with each other without doing like market buys or market sells. So it basically just matches orders between people that are like customers on that exchange. It's essentially just a benefit that's like approved by the regulators to allow some sort of like, it's sort of like an incentive for the exchange to like allow trading. So some exchanges allow it, some don't. You know, there's a push to go to 24-hour trading. You know, Robinhood's trying to get 24-hour trading. Some other exchanges are trying to get extended hours trading. But essentially that's all it is. It's basically just extra hours when trading could take place after the market is actually closed. And they just restrict the way that you're able to trade. So you can't just be like market sell, dump my position, or market buy, you know, give me a position. It only uses like the matching engine to allow, you know, basically trades directly between a buyer and a seller. So that's what it's all about. And it's just essentially just an incentive to allow trading. So, you know, in the future, are we just going to have 24-hour trading all the time on everything? Are they going to be doing like, you know, third party fractional trading of stocks like through overseas exchanges? Probably. Who knows what the future will hold? I imagine eventually we'll go to a 24-hour all-time trading everything world. Even if the actual stock market is not open, you know, if it stays like the same hours, I think eventually we will have like 24-hour trading like mainstream. But that's what it's all about. It's basically just a little incentive that allows people to make moves before and afterwards. And then that is what results in these like massive gap up and gap down, you know, based on like what takes place before or after hours. So let me jump over in the chat here. I will see what you guys are saying. What's up, Rick? Good to see you, brother. Hey, glad you're here, man. Definitely glad to have you. Okay, I missed one there. Atlas Omega, good to see you. Can't wait to watch. Hey, appreciate it, brother. Thank you. Glad to have you. XX Angel says, please talk about bear market minus 80% drop. S2F. Please. Please talk about bear market 80% drop. Okay, that's the spam. Sotos, what's up, brother? Good to see you. Rick says, let the man speak. Exactly. Who cares about Kathy? No one. I'm trying to make a point. Yeah, that's all it is. Mark says, if you're impatient, just go and watch the video after he's done. You can fast forward then. Yeah, true. Sorry, I'm just excited. Hey, nothing wrong with being excited, man. But, you know, I have a pretty standard way I do this. You know, because if I jump in the chat every like 2 seconds, I'll lose my train of thought and all that stuff. So, what's up, CW? Good to see you. CW is not a bot. That's what's up. So yeah, let's jump right in. We will start where we always do and make our rounds here. I will talk about some of the potential drops here in the traditional market and cryptos. We don't want to get too ahead of ourselves just yet. We're not 100%, calling for some big 80% capitulation drops in crypto or stock market or whatever. But I'm okay with talking about, potential things because, at this point in time, we missed our S&P target by like literally dollars. I was calling for 4,800 S&P last year, and we literally missed it by like fractions. So I think we talk about some of our lower end targets. You guys know too, a lot of you that have been following me for over two years now, when I was calling for the initial drop before CVD ever happened, when I first made this channel, that I basically called the S&P and Dow Jones drop within, it was like less than 0.5% away. And I called that, it was like 2 months in advance. So, well, maybe 3 months in advance. But regardless, it was pretty well nailed. And I don't do it just based on like crystal ball or anything. I use the same techniques over and over again. And that's why it's so important to be consistent and use things that actually work and are quantifiable. Because if you predict something one time perfectly, that's amazing. And that's great. And as long as you make a bunch of money off it, that's awesome. But if you can't repeat it, it's pointless. You know what I mean? It's like winning the lottery. Like, you could get lucky once, but like, you can't write a book afterwards, like how to win the lottery, like how to pick winning numbers, like how I made $1 million in one day. Like, it's pointless because it's not repeatable, unless you're like that random guy who's won the lottery like 5 times, in which he probably won't write a book. He'll just keep winning it. Hey, good to see you, Galt. Hey, buddy. All right, so TNX, not doing much of anything. Just kind of going sideways right here, just bouncing between the 8 and 21. But let's keep in mind, the most important thing is that we're just consolidating after a breakout. We broke out from cycle highs right here. This was our capitulation dump. We came up and we put in a new high. We broke out above that high, and now we're just consolidating above that high. So if we hold this area, never break down below here, it looks the strongest. If we break back down and just put in a higher low, it still looks strong, but not quite as strong. But if we look here at the indicator oscillators and we see what's going on, we're seeing a bunch of red histograms. We're seeing a hard sell, and we've left the bullish control zone, but the price action is just going sideways. So to me, this looks like a bullish reset. When price action does nothing, it basically goes sideways, but the indicator oscillators trend down. It's basically just resetting them so that we can move higher. And that's almost always what we see when that happens. We might even get a break back down. Maybe we come down a little lower. But overall, this to me just looks like the market pricing in Fed rate hikes before they actually take place. So even if the Fed says, okay, we're going to control the short end of the curve, we're going to keep doing this, keep doing that, Fed fund rate set at this, at that. If the market decides it's going to move the rates, the Fed really can't control it, because the only thing they really control is like super short end of the curve. They control like super short end of the curve. So when we start looking at like the 10-year and the 25-year, and the 30-year, that's a whole different game. 20-year. But we're already seeing the yield curve starting to invert on the longer time frames. And a matter of fact, I pointed this out, I don't even know, maybe three or 4 weeks ago or something like that, that we had seen like the long end of the curve already inverting. And now I'm hearing other people talking about it. So whenever we talk about something, and then, a couple weeks or a couple months or whatever later, everybody else mainstream starts talking about it, that's always a good sign, because that means we're positioned ahead of the pack. And then when it becomes mainstream, by the time everybody else gets on that bandwagon and they're all like, oh, this is happening, that's happening, we're already positioning ourselves for the next move, because we know that everybody else is late to the party. Because if we hear other people talking about it, we know the masses are still months behind. So when we were talking about, when this whole thing went down and we started talking about the supply chain constraints and the inflation, everybody else was talking about deflation and the economy going away and, all these issues. So then by the time the inflation started to hit, we're already on our long-term deflationary narrative. because we know that it's not sustainable, and then eventually GDP is going to drop, and then eventually we're going to go back into a deflationary period. Inflation is going to peak out. Even if inflation stays high, we know that those numbers are calculated year over year. So the actual rise or the rate of increase in inflation will drop. Because if we have a 10%, let's say a 10% inflation, year over year, well, by the time the next year rolls around, in order to have 10% inflation, we would have to have 10% more on top of the previous year. It doesn't go from like some fixed number in the past. So we know that on a long enough time frame, all inflation is transitory. That's why it was like so laughable when Jay Powell was saying all that stuff. But I mean, we're seeing how all these things are playing out. It just takes a little time. Sometimes you're expecting things to happen fast, and they don't happen nearly as quickly. But when you look back at them, like in retrospect, I mean, this all started, this whole Rona dump was like 2 years ago. And now here we are, and it's like, oh, that was 2 years ago. Damn, that's wild. And it's the same thing with like the dot-com bubble burst. We were talking about how the market was basically going through like a cyclical, like rolling correction through like tech. And I was talking about how when you look back at a chart, or when you talk about the dot-com bubble burst or the global financial crisis, like on paper, it looks like it just happened. Like it was a snap of a finger and then everything crashed. But when you actually look at it, when you live through it, you realize it's like a multi-year period where you just see like it's, dominoes falling, one thing after another. And then after a while, you're like, oh, wow, that just all happened around us. And I didn't even notice because I'm living through it. Or it doesn't seem as extreme, or you understand something's going on, but you can't quite put your finger on it. But then when you look back at it, it's very clear what happened. And that's exactly that's what's going on right now. We're living through history right now. So, 90% of the people don't understand what's going on. Like, people are like, oh, this inflation, what's causing all this? This is crazy. And it's like, well, it's obvious. We were talking about it before it happened. It was so obvious. Policy shuts down production. So now we have less goods and services. And then policy gives people money. So we have the same amount of money or more to spend. So there's less goods and services. There's the same amount of money or more money chasing after those goods and services. Therefore, what happens? The price of them goes up because there's more demand than there is supply. So that causes the inflation. That's the supply constraint inflation that we were talking about this whole time. So everybody that's saying, well, no, this has nothing to do with supply, it's all demand, they're clearly wrong. Because if we still had the same amount of supply, we wouldn't be having these issues. The problem is the supply, not the demand. I mean, the demand's not helping because we kept the demand the same or increased that. But in all actuality, if the supply chain never broke down, if policy didn't shut down everything, if we just kept going about our business, and just pretended like this wasn't a thing and just went about our business, and, obviously I'm not trying to desensitize people towards what happened. Hindsight's 20/20, obviously. But if we just went about our business, the whole world would be exponentially better off right now as far as inflation goes. But it's not, because we took all these measures and we cut off supply. So let's look at the VIX now and see what's taking place. We talked about this. Okay, so we've been in this massive, sideways forever horizontal channel. Inside of that, we have our CVD peak channel. This is market crash. This is when the markets were crashed, the absolute lowest. So the VIX, the volatility is at the absolute peak, highest, when the market is at the absolute lowest. So massive volatility is a bottom in the market. So now here we have been basically just melting down inside of this descending channel since then. And now we have broken out of that channel. Now we're forming this ascending white channel. So we have multiple peaks on top here. And what we're looking for is, obviously we're talking about if this level held, but more importantly than anything, we want to see either this white line at the bottom, this ascending channel support, hold, or we want to see, even if that doesn't hold, we want to see a higher low. So we have a low right here, basically a double bottom now between these 2 points. And then we have a higher low here. So we want to see a third higher low right here, or even the same low. But essentially we're in our blue box area right here for support. And what is that support? Well, it's the heart line of the macro channel. This is just the central portion of the channel. So we were operating in the top half of the channel right here. Then we broke into the bottom half of the channel. And then this heart line was acting as resistance. We pushed through it a couple of times, but we couldn't maintain above it. Now we're breaking above it. And now we want to see, is this going to hold that support? And then are we going to continue moving up right here? Because if we continue moving up, we're probably going to end up back in this red zone eventually, you know, kind of chopping around through here. And we know that being in that red zone is going to correspond with a macro market crash, you know, because that's our volatility of the S&P. And when do we get volatility? Not when things are going up. Everything's calm and chill and relaxed when it's going up. You know, this is what it looks like when the market's melting up. This is what it looks like when the market's melting down. So just for some perspective there. So oil is just kind of hanging out right here. We're not getting a ton of, you know, anything, just kind of doing its thing. Obviously, there's lots going on with Russia and all that stuff. And we'll have to see how that all plays out. Everything with OPEC. You guys know macro. I'm still very bullish on oil. I still think it hits $100. You know, it's going to be a slog to get up there. Maybe it's just one big candle. Who knows what's going to happen? The fact of the matter is, though, you know, energy has been a strong trade for the last like year or so, and energy has been a macro underperformer for like literally, you know, a decade. So we don't want to overstay our welcome in this. You know, we've been talking about uranium, talking about how that basically has peaked out a lot of these other commodities, and essentially, like, you know, the important thing, same with gold and silver. We were all over gold at $1,300. We were all over silver at $17. But then by the time they were peaking out, we were pulling back on those because the trade was done. The investment was done. The move was done. And then we have to reallocate our capital somewhere intelligently. We cannot just get married to our ideas. And sure, gold is off its lows a little bit, but it's basically gone down and sideways for over a year. I mean, silver was hitting $30 a couple times, and now we're back at what, like 22, 23? So that's dead money. Not only is it down, you know, from the peak, a lot of people were buying at the peak. Not only is it down from the peak, but, you know, it's been dead money for the last year. You could have put that anywhere but Cathie Wood's fund and you'd be up. So Dow Jones, I mean, look, we had a nice little bounce off of the 200 exponential and the 200 simple. But, you know, is this just a reflex rally? I mean, bots and algo is going to keep buying the 200 exponential and simple, assuming that they're going to continue to act as support until they don't. So that's what we're paying attention to. We have multiple green histograms. We have a hard buy signal. We have a very powerful V bottom off this range for now. Now, what we need to see is, do we come back up here and put in a new high? And I'm going to tell you, if these big names are having trouble, we're not going to be able to put in a high. Because, you know, obviously the Dow is what, like 30, top 30 companies. So, you know, they're strong, obviously, but there's still a couple of them that are pushing this thing to new highs along the way. You know, the S&P, obviously a little more diluted, you know, and then obviously Nasdaq, well, and you guys know how that goes. But let's take a look at, now we've had our monthly close and everything, and just for perspective, see what's going on here. So we had a powerful close at the end of the month, got bought all the way back up to the 8 moving average, and closed back on top of it. So that's not bad. That's pretty good. I mean, we didn't bearishly engulf. We closed above the 8, and we had a pretty aggressive buying wick come in. So that is pretty good. The next step is obviously to close a new high on the monthly. Obviously, we have plenty of time to see what happens there. But that's what we were talking about here. We have the hard sell signal, but we have not exited the bullish control zone. So that's what we're paying attention to. Until this blue stochastic on the Jewel Thief comes down below 80, this is not a confirmation sell signal. So we see here we got the hard sell way up here, but until we exited, that did not count as a confirmation sell signal. Here it happened at the same time. The hard sell cross between the pink and the blue happened at the same time that we dropped below the 80. And we can see in price action how that corresponds. That was the peak right here in 2018. This was the CVD peak right here. You know, obviously the monthly time frame doesn't give us a lot of time to like react to it. But we see the weakness here, multiple red histograms. You know, we're running out of steam. We know that. And we looked at the weekly, we looked at the daily. So we have a pretty good idea as to what's taking place here. This was the beginning of our bearish divergence playing out. We did something important here. We have a high, but we took out, well, arguably on the daily, we didn't take out the low technically by closes. We basically closed, you know, essentially at the low right here. So the most important thing to watch now on the Dow Jones is from this high right here, we come down and bounce. Are we going to put in a new high? Because if we don't put in a new high, then we start getting basically a high, then a low, then a lower high, and then we have to look down here to see if we put in a lower low. And that is how a downtrend begins. The same way on the VIX, we were talking about, we're starting to put in an uptrend, same way that the Dow Jones could start putting in a downtrend. Now, this is going to stay the strongest for the longest. And obviously, we see that with the correspondence with the 200 moving averages. Did you want me to, were you talking about the 82%? Are you talking about in crypto or are you talking about in the stock market? Angel, let me know. So the S&P looks very similar to the Dow Jones as well. We see the same thing happening. Hard buy coming out of the bullish control zone, bunch of green histograms, bouncing the 200 exponential and simple. But is this just the algos buying up price action? Is this just the buy the dip mentality? For now, I mean, that's what it looks like to me. Now, again, if we take out this high right here, it looks better. But we have already, not only did we destroy this previous low right here, which is, the beginning of potential like danger zone, but we took out not quite this previous one right here. So we were able to bounce that pretty comfortably, which is definitely nice. And then if we go to our monthly and look at that, same thing happened. We got bought up. We have the hard sell signal, but we have not exited the bullish control zone. We see the last 2 times that happened, the exact same thing as well. And now we see this is on the monthly here too. This is what I pay attention to on the TJD, TDMACD. 2 red histograms is a big deal to me. Once we see the second red histogram print, which we will not see for another 26 days to the end of this month. Once we see the second red histogram print, that to me is my first okay, I'm good now. Time to get out. Time to, lighten the load, de-risk, whatever. But obviously, if we see on the weekly here, this is us just trying to avert that cross. Bearish divergence playing out, trying to avert the cross. So now we need to see how this week closes will be a big deal. Because if we close above where we're at right now, it's going to look like we saved this cross. If we close where we're at or below, the cross is going to happen basically. And then we're going to see essentially that 821 cross down for the first time since May of 2020. Which is essentially just going to be the 2-year bull market over. And now it's time to have whatever correction we have, which will probably be the reversion to the 200. Okay, Bitcoin, I got you. Will do, brother. So that's what we're paying attention to. As far as I'm concerned, nothing has happened that's any different. This to me is a reversion to the mean trade or our dead cat bounce or, attempted rally the same way we would expect. We talked about this, not unexpected at all. So this is our IXIC Nasdaq. So we see obviously this is much weaker, but we're again getting the reversion to the mean. We broke down below the 200 exponential and simple, lost them as support, found a temporary bottom, and now we would attempt to try to get back to them. So at this point in time, is the Nasdaq overvalued or undervalued? Well, that's what this 200 moving average is all about. When we're above the 200 moving average, it means we're overvalued, but we have momentum on our side to the upside. Because we're looking at the last 200, on the daily chart, we're looking at the last 200 days of price action, and we're above the average, which is what the blue lines are. So now, for the first time in 2 years, we're below the average. So that reversion to the mean is just the price action being moved back to the average. So this is when the market is expensive. This is when the market is cheap. But if the momentum is on your side, it's not necessarily a bad thing to be with the momentum when it's overvalued, because everybody else is with the momentum too, which is why you're buying the dip on a bull market. But now if we're potentially going into a bear market, which we had technically flipped over the 200 exponential and simple, but then we had the reversion back up. It has tried to save the 200 simple for now, but we're still underneath both of them. So we need to wait and see how this plays out. But essentially now we would lightweight expect the 200 exponential and simple to act as resistance. So if we can get back through the 200 exponential and simple, close back on top of them, consolidate, that will look good. And then we can reclaim momentum and start moving back to the upside. And that's fine. We're okay with that. I don't need the market to go down to make money. I actually prefer market continuing to go up. But we have to let the market tell us. And I mean, it's okay to take scalps. We can buy, quick little plays or whatever. We can do what we want to do. But for momentum trading, for long-term trading, investing, whatever, we have to stick to the game plan. And the game plan is to trade with the trend. So right now, we're sorting it out. The buyers and the sellers are like arm wrestling right now, strapped down, fighting to see who's going to win. And then once we see a clear winner, then we can position ourselves for the next 6 months to 2 years of price action. Whether that's bullish or bearish, that's fine. We really don't care. Honestly, I would prefer that everything is bullish because bull markets are the easiest. But bear market, that's fine too. What we don't want is just get chopped up in the meantime, trying to pick a direction and then sounding like all these fools that are like the bottom's in, the top's in, the top's in, the bottom's in, and just getting chopped up left and right, paying, fees to trade in and out of positions, taking loss after loss after loss because they're, dumping this, then buying that. Perfect example. Your boy, Paper Hands Kevin, Paper Hand Paffrat, dumps all his positions, rebuys his positions, dumps his positions, rebuys his positions. You're going to look like a fool when it's all said and done. Getting chopped up. So we see the Russell broke down very clearly in a bear market, and we're seeing, you see the difference between the move that the Russell has gotten in comparison to even the Nasdaq, let alone the Dow and the S&P. This is so weak. Such a trash bag index. No surprise though. Look at that measure move though. Proof that this shit is science, not luck. This is just literally the channel that we were trading in forever. And that's our measure move to our target area perfectly. Going sideways forever in this thing. And then we get the breakdown. The 200 exponential and simple have rolled over. And what was our prediction? We come down to the buy zone, clear the 236, hit the measure move. And then what is our move? The reversion to the mean, which is the push back up to retest what was support as resistance. So we expect to move back up on the Russell somewhere between 2130, possibly as high as 2180. If we get back inside the channel, it will look okay. It will look more similar like this. This is obviously our throw over, our failed breakout. Whether that's intentional or it was a breakout that failed, doesn't matter. We don't have to worry about if it was manipulation, if it was a trick, or if it was just a failure. This looks to me like maybe it's a spring. We get back inside the channel, we consolidate, we burst to the upside. More likely than not, though, based on the aggressiveness of this move and the overall direction and loss of momentum, more likely than not, this is sticky. So I think we probably come back up, hit this resistance, was support, is resistance now. That's our SR flip. And then we see continuation to the downside. And depending when we get there, 200 exponential and simple will be continuing to the downside as long as we're below them. We run into them in the bottom of the channel at the same time. The more things we run into at the same time, the harder it's going to be to clear through those things. So, but we have to let the market tell us what's going to happen. Can't be presumptuous. All right, jump back over in the comments real quick. Oh, we got a bot. 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 Hey. All right, where we leave off at? CW, I'm not a bot. Crypto Gold, what's up? Cool sheet. Bitcoin dead under the D200s. Yeah, it's not dead yet, but it's definitely not looking good, man. But it's not like we haven't seen this coming for literally months. Atlas says trend directional equals all that matters. Yeah, 100%, man. Trade with the trend. It's like we always talk about this metaphor all the time. You guys know I'm famous for my metaphors. Most of them are inappropriate. So, but this one is legit. We can swim upstream in a river for a while. We can definitely do it. We can swim against the current for a while, but eventually we get tired. And then, the stream or the river or the current, whatever, takes over. And, we either drown or get pushed downstream or we have to get out of the water, whatever the situation is. But if we take us, an inner tube, a little floaty toy or whatever, pick your poison. You can get one of those little, floating unicorns or whatever. Grab a little beer cooler, fill it up. Or, what's popular now? I don't even know what these kids are drinking. They're gluten-free, flavor-free, alcoholic beverages, whatever it is. grab you some Four Locos, throw them in a cooler, jump in an inner tube, you get in the river, and you just float downstream. You don't have to do nothing. You can do that forever. And that's what trading with the trend is. Trading with the trend is filling up a cooler, jumping on a little floaty, and just floating wherever the market takes us. And it's just so much easier. Every once in a while we can jump off our floaty toy and, swim against the stream for a minute or whatever. But we don't want to do that for extended periods of time. We just want to go with the flow. And that's what the market's all about. Trading with the trend. Christoph Kozlowski says PayPal down too. Yeah, we looked at PayPal right at the beginning of the stream, man. Same exact thing. Just another one of those just getting wrecked. What was the other one? Pinterest was down. PayPal was down. Angel says, guess we're already in another financial crisis. Inflation and taxation is the one way for the government to survive. Yeah, I mean, the inflation is the way that the government destroys the debt by inflating away the buying power. So, their goal is to inflate away 2% per year, and then they can kind of make up for, some of these like long-term debts that they have and everything. And then they just lie about the actual level of inflation. So they're like, oh, yeah, it's only 2% or it's not quite 2% or whatever. But that's why Jay Powell is just sitting back, letting the inflation do its thing for a while. He's like, oh, it's transitory. Oh, it'll probably go away. Oh, we'll be fine. The truth is, though, is, the Federal Reserve wants the inflation. They ask for the inflation. If they can get away with 2 years of between 5 and 10% inflation, whatever it is, think about how much of the debt that erases because they've inflated it away through the diminishing of buying power. It's not like they're dumb. I mean, they've got like thousands of like smart ass people with like Ivy League educations. They're not dumb. They play dumb. They act dumb. They think we're dumb, but they're not dumb. CW says, smash up that likey button. That's right. Smash up that likey like. Atlas says, you too, bro. Where do you get your information on Bitcoin, like world events, etc.? It has an effect on it. Man, I really don't pay attention to fundamentals, Atlas. I mean, I might pay attention to them, but I'm not a fundamental guy like that. I mean, the fundamental story of Bitcoin, like long term, I used to be all about, but it's become corrupted completely. Like, and that's part of why, like, it becoming mainstream. The derivative market on Bitcoin basically has killed it. Like, the whole point of Bitcoin is artificial scarcity, and that was the fundamental reason it was so good. There's only 21 million. Hooray! But what here just destroys that whole argument. Gold is an actual metal commodity that is monetary and also like industrial. Like, it has an actual purpose, but also is a great store of value and has been for thousands of years. So it has the longest history. It's monetary and it's industrial, and it never goes away. So that's everything great. That's literally the basis of everything. And then Bitcoin's built around that. And then what is the main argument behind, gold and silver in these commodity markets is that they're influenced by the paper markets. And so they're suppressed by central banks or whoever. Sure, I'm not disagreeing with that in any way. But what allows them to do that is paper trading. So what is the paper trading? It's derivative markets. So if you have actual gold and you're going to trade it with somebody, you trade gold for gold or gold for goods. There's no derivatives. There's nothing else in between. But then when you start saying, okay, I'm going to store my gold here, and then we'll just trade a paper note that represents that gold, and then you can go in and cash it in at the bank and pick up that gold, but then I don't have to like carry it around with me. I just carry the IOU, which is essentially what money is, or currency. So as soon as they develop these derivative markets, it changes the whole scope of things, because that's what allowed them to manipulate gold. Taking us off of the gold standard, is basically when Nixon took us off the gold standard is when the paper markets allowed the manipulation of gold. And then you have derivative markets on top of that, which is basically just people betting on the price of something. So you have the actual underlying markets, and this is all back to the fundamentals of Bitcoin and crypto. The actual underlying asset, the gold itself, is the value. And then on top of that, you have now IOUs for that value. So as long as those match up, you're fine. But then on top of that, you have derivative markets as well. So you have fractional reserve banking, which allows them to hold only a certain amount of the quote unquote gold, so to speak. And then they only have to keep, you deposit $100 worth of gold at the bank, they have to keep 10 of it. Well, if it was 10% still. And then they can loan out the other 90 to other people to make money off it or invest or whatever it is. That's like the fractional reserve lending portion of it. And that's how a bank run can occur. Because everybody shows up at the same time to get their stuff and they're like, oh, $1 million worth of people want to get their stuff right now, and we only have $100,000 or less, depending on what the fraction is. And that's what the reserve comes from. It's how much money they're required to keep by law, which at some point in time has been zero, and arguably is still. So then on top of that, you have the derivative markets, which is basically just people betting on the price. So instead of people actually buying and selling gold or buying and selling Bitcoin on an exchange, which alters the price, because there's, obviously what makes the price move. If there's more buyers than sellers, the price goes up. If there's more sellers than buyers, the price goes down. So imagine you have that whole dynamic on one side, and then completely separated from that dynamic on another side, you have people just betting on the price. You have two dudes just standing there looking at a chart, and the one guy goes, hey, I'll bet you $50 gold goes up. And the other guy's, oh yeah, sure, I'll bet you 50 gold goes down for sure. And then they see what happens. Gold goes up. The one guy pays the other guy $50. Does not ever buy gold, does not ever sell gold, never affects the price of gold. It's literally just people speculating on the price without actually touching the underlying. And that's what the paper markets are. That's what these derivative markets are. So now that there are derivative markets for Bitcoin, who cares if there's only 21 million Bitcoin if people are just betting on the price without even affecting Bitcoin? It destroys the whole argument of scarcity. The same way that these central banks and bankers and whoever are able to manipulate the price of gold, they're now able to do the same thing on crypto. So the artificial scarcity of crypto, the whole idea of crypto, of Bitcoin, was to copy gold's scarcity model, and create an artificial scarcity. But now it's even more flawed, because now the artificial scarcity is gone, one, and two, nobody really needs Bitcoin for anything. Like Bitcoin, sure, it's a store of value because it always goes up, or at least holds its value, so somebody will pay you more for it in the future than you paid for it. But at no point in time does anyone actually need Bitcoin for anything, which is the difference between Bitcoin and gold, which is why that argument is actually weaker for Bitcoin on a long enough time frame. So anyway, that's the whole fundamental aspect of it that used to have me super bullish about Bitcoin, that now I just don't have the same feeling. Now, it doesn't mean I don't think Bitcoin one day goes to $250,000 or $1 million or whatever. It doesn't mean that. It does not mean that at all. But what it does mean is that things have changed. And when things change, you have to readjust, in accordance with those changes. So now that there are derivatives markets, now that there are futures markets, now that there are, all these different things going on here, paper trading, it's a whole different game. And people got to realize that. And, they don't get it. They don't want to get it. They don't care, whatever. It doesn't matter. That's what puts us ahead of the game, is that we do know that. We do care. But yeah, world event stuff, man, it's the quote I always say, Atlas, is show me the chart, I'll tell you the news. And that's the perfect way to put it is, we see a dump coming ahead of time, we call it out based on the things we're looking at in the technicals, and then 3 days later it's like, oh, China banned Bitcoin, and that's why it crashed. Or we talk about a move that's about to happen, there's about to be a big pump, and then the big pump happens, and then people get online and they're like, why did Bitcoin pump? And there's like 10 people putting out articles and they're like, El Salvador is buying Bitcoin, and they're like, it's because of El Salvador. No, it's because of the market makers, movers, the whales. It has nothing to do with the news. The news just gets people excited about the move that's taking place and helps them to justify why that move is happening, in my opinion. Now, on a long enough time frame, fundamentals are important. On a business, fundamentals are important. But in crypto, man, it's got to be about the technicals, because there is no real fundamentals. There's no earnings. Cool Sheet says, but never counter trade Nancy Pelosi. She loaded up on more calls. Bull market may not be done yet. Yeah. Hey, look, just be careful, man, because like I said, a lot of people are going to be proved wrong here, if things turn. because they're always right until they're wrong. It's been a bull market for the last 2 years nonstop. So if all of a sudden it flips again, think about how many people are massively bullish. I know people that have been invested in stock markets for a long time. And, right before the CBD dump happened, it was January. I was telling some close friends and family members, be careful. Market's about to crash. Giving them specific reasons why. Semiconductors, transportation, yield curve inverting, all these different things. And they're like, no, da 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 da. And 2 months later, this is a perfect example. I'm looking at the charts and I'm saying we're about to have a massive crash, a meltdown, a quote unquote black swan event is coming. And then what happens? A couple months later, the virus herd around the world hits, and then everything gets shut down and all. How did I know that was coming ahead of time? I didn't need to see the news because we had the charts, and the charts are much more powerful than the news is. So let's do our crypto next. I think I got through all the comments there. I saw they shut down that Twitter account too, or at least heard about it. I don't use Twitter, social media, or whatever, but I did think that was funny. They're like, Pelosi was definitely putting some pressure on them. Like, cut that shit off. I don't want anybody knowing what I'm doing. All right, just was grabbing a drink there. So yeah, let's jump in on Bitcoin here, and we can look at the long time frame potential. So we see here on the spot chart, this is Bitstamp on the daily. We see we have very clearly lost the 200 exponential. The slope is to the downside. Now in the spot market, we see on the futures, it has already rolled over. But because the spot market had such a powerful move while futures chart was closed, we actually have the 200 simple back moving to the upside. So even though we're substantially below it, it does actually have a positive slope right now. But we're pretty far below it, and we're probably, it's all but flat at this point in time. I don't know if you guys can actually see that. It's all but flat at this point in time, so we're literally like days away from it rolling back over, and we're pretty far below it. So we need a powerful move back up above 50K to basically save the trend at this point in time. Now we know that what typically happens is, or what eventually happens is, we get that reversion to the mean play, which is a retest of the 200 exponential and simple. So we do expect that to happen. Now the problem is we don't know when it's going to happen. So is it going to happen right now and we jump back up to like 48, 50K and we can make a nice little 33% scalp off of it? Or are we going to drop down to, 30,000, and then by then these moving averages are going to be down here at 40,000, and then we get the push from 30 to 40? We don't know yet. So we have to wait and look for that momentum. That's one of the few counter trend trades I like to play, which is the move back to the moving average, the reversion to the mean trade, as I like to refer to it as. The mean being the 200 exponential and simple, or the average over time, and then the reversion being the retest of that. So when we're in a bull market, the retest of it is buying opportunity. When we're in a bear market, we could take a scalp towards it if we want to the upside, but in all actuality, the real move is to short the 200 exponential and simple, or sell our remaining positions that we still have open into it when the trend has confirmed bearish. So that's what we're looking at. That's what we're paying attention to. So now we do know that these markets trade very technically, and we often see bullish and bearish divergence giving us a clue. That's the whales, the market makers, leaving us breadcrumbs saying, hey, my dude, if you can hear me right now, if you can decode this message that we're leaving on this chart, we're going to do a big counter trend move. We're going to have, we're going to let this divergence play out. We're going to see, a big top or a big bottom or something like that. And they leave these little clues in the chart for us. We just have to find them. We have to be paying attention. But the problem is most people don't speak the language. They don't speak the divergence language. So we're in here decoding that shit so we can be ahead of the move. So we see here a peak, a low, a trough. And then here we see a higher low. And then here on price action, the corresponding low right here, we see was right here off the 200 simple. And then we see here, this is a much higher low. This one on the TJD, TDMACD, and this a much lower low on price action. So that is bullish divergence between those 2 points, telling us that what's taking place right now, this push to the downside, this continuation to the downside is unsustainable without at some point in time a reset of the indicator oscillators so that the price action and the indicator oscillators can come back into line, because we're seeing them diverge. Right now, price is continuing to go down, but the indicator and oscillator are barely using any energy and still pushing down. So we know it's not sustainable. We don't know when it's going to happen though. So we pay attention over here. We don't see that same divergence taking place on the Jewel Thief. So we have some confirmation, but we don't have as much confluence between our various indicator oscillators. So what we'd like to see here is a third drive of bullish divergence. If we push down here again and we go even lower, we take out this daily close at 35,000. That's what I'm looking for. I'm looking for a lower close on Bitcoin price action below 35,000, and I'm looking for a higher close on the macro of this. So I want to see this trend back up and us just kind of do nothing. Nothing really happened. And then I want to see it come back down, and I want to see a 1, a 2, because this is just part of this. This is part of this move. The same way this little guy is part of this little guy is part of this. That's 1 drive. That's 2 drive. I want to see a third drive come down, and I want to see it bounce the slope of the moving average right here. And when that happens, that's going to give us our third drive down, and then that's going to be our reversion to the mean play. That's what I'm looking out for. Does it have to happen? It does not have to happen. Sometimes 2 drives will pull out. Sometimes we'll just go lower. The indicator oscillator will go lower. The price action will go lower, and we'll invalidate the divergence. But the majority of the time when that happens, we'll get a really nice play out of it, and probably something like a 25 to 30% move. And it'll be a quick move too. We'll make in a couple days what most people will make in a year if they're lucky. So that's what we're paying attention to. That's what we're watching for. Does it have to happen? No, but we know in order for that to happen, the same way that we got 3 drives of bullish divergence here or 3 drives of bearish divergence here, we know that when that plays out, something will happen. We will flip the 8 and 21 in the opposite direction first. So here we get 3 drives of bearish divergence, the 821 flips, and then we put in a lower high, and then the divergence plays out. Here we put in 1, 2, 3 drives of bullish divergence, and then we flip the 8 and 21 to the upside, and then the move plays out. And we have a little retest in here, whatever. So that's what we're paying attention to. We want to see another drive of divergence ideally, but most importantly, we're watching for the 8 and 21 flipping back to the upside on the TJD TD Master. And if you don't know about TJD TD Master and the Jewel Thief, these 2 are exclusively available to group members who show their support. One-time contribution helps to just fund this whole operation basically, and me to show my appreciation for those that go above and beyond. If it's not for you, if you don't have the extra funds, totally understand. That's completely fine. There's like over, I think, 10 or 12 other free indicators that are available on TradingView. It's all down in the notes. Go grab those up. The TJD TDMACD is one. The old version of the Jewel is one. I have other moving average indicators as well. It is what it is. I completely understand it. That's totally fine. But this is available exclusively to the group members. And it simplifies everything, makes your life so much easier, and just makes all of this make way more sense. So when this 821 crosses back to the upside, when the divergence plays out and we get that reversion to the mean play, what we'll be paying, we'll take a scalp on that. We'll make 25, 30% on that. But then what we'll be paying attention to is when we get back up to 200 exponential and simple, we'll take profits and then we'll sit on the sideline. We'll see what happens. Does this continue to sell off? In which case we will switch from buy the dip mode to sell the rip mode. Meaning we're going to swim with the trend. We're going to float downstream instead of floating upstream. And that's what we're paying attention to. So now let's look at the macro on Bitcoin and see what's going on here. And then we'll get into like the potential big downside targets. So now we've been talking about divergence. Look how clear it is here on the weekly. So here we have a peak on the weekly, and then here we have a higher peak on the weekly based on our candle closes. And then here if we look at our indicator oscillators, here we have a peak and here we have a lower peak. And then again, if we look at the TJD TDMACD, here we have a peak, here we have a lower peak. So on price action, we have a higher peak. On our indicator oscillators, we have a lower peak. So we have bearish divergence taking place at the top of the trend, a potential double top bearish divergence taking place. But now we have sold off quite a bit down here, and we're inside the bearish control zone, meaning the bears are in control, but we're at a potential area where we could actually put in bullish divergence, because here at the bottom we have a low of like 31.5 on the weekly, But here we have a low of 36,000. And then here on the actual indicator oscillators, we have a low right here of 1650, 16.5. Here we are lower than that already. And then again, the same thing. Here we have a low of negative 2255. The numbers don't matter. And then here we have a low of negative 3099. So if we turn this back around, if we see 1 or 2 green histograms, ideally, 2 green histograms really, but if we see 2 green histograms and curve back up here, and then we have a low right here, and we have a higher low right here, we will have a low right here and a lower low right here, a low right here and a lower low right here. The same way we have macro bearish divergence and a potential double top, we will have macro bullish divergence and a potential double bottom. So we know what has to happen for that to happen. Bullish divergence, and then potentially a push back up all the way back to, 60,000. Definitely still a possibility, and we don't want to rule that out. We do not want to rule that out. But we know what has to happen on the 4 hour. We know what has to happen on the daily for that to ever happen. So that's what we're paying attention to, because this is going to take 2 weeks of green histograms, which means we're going to have probably push back up to the 200 moving average on the daily, which means we're going to have reclaim the trend, which means we're going to potentially be going back into a long position for the reversion of the mean play, and then maybe reclaiming the 200 exponential, and then seeing that continuation to the upside. So we'll already be positioned off of our scalp trade, off of the reversion of the mean trade on the daily or the 4 hour in order to capitalize on the weekly trade. So what starts as a scalp turns into a position, turns into an investment if the trend goes back to the upside. So we still have potential for bullish divergence. Now, what would have to happen to invalidate the potential bullish divergence? Because we don't have bullish divergence right now, because we could just very easily, all that has to happen now, we already have lower indicator oscillators right here than the previous peak right here. So all that has to happen to invalidate any potential bullish divergence is a close below this candle right here. So if we literally close below 31,650 on the weekly, it's invalidated. It's done. It's over. And there's no bullish divergence, and now the bearish divergence reigns king. And there's no potential for bullish divergence, no nothing. And then the likelihood, if we close below this, is extremely high for us to come down to 200 exponential or simple on the weekly. So at that point in time, we'll have put in a high, then a low, then a higher high, then we'll have put in a lower low, because we'll have taken out that low. And then at which point in time, we would expect eventually a push back up, reversion to the mean on the weekly, and then we would expect to put in a lower high once again, and then again a lower low. And that would be the continuation of what amounted to our A, B, C correction pattern of the expanded flat of the 5-wave Elliott wave structure. But we don't want to just start counting our chickens ahead of time. We don't want to just assume this is going to 20K and getting too excited about it, because it is possible we get bullish divergence and we push back up to 50, 60, 100K. Definitely still a possibility. And that's us just not being biased. Matter of fact, if anything, I'm biased to the upside because it's easier to make money to the upside. But I'm not going to try to fight the market. I'm not going to swim upstream. Not going to do it. No, thank you. I'm too lazy for that. I'm too lazy. So on the monthly, we see we have broken down. We're at the 21, hanging on for dear life. Every previous time, this was our 2017 top right here. This is what happens when we got back down to the 21. We just went sideways on it, couldn't get back above the 8, and then everybody was getting super bullish right here. And, back when I was actually getting started in social media or, putting out my stuff online or whatever, I was calling for a drop to 3,000, and then we had the capitulation. It dropped literally to 3,000, at which point in time, we loaded up the bags, and then we just played the patient hunter game. Just sat around waiting. Buying Ethereum under $100, like $85, $86. Buying Bitcoin at $3,000 and $4,000. And then eventually, when the time is right, we obviously get to reap the rewards. But this is what happens when we get down to the 21. Consolidate, 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 breakdown. Here we get back down to the 21. Consolidate, 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 push back up, try to save the trend, and then look what happens there. Breakdown. So we don't want to see, now we're closing at the 21. We don't want to see this continue to happen. And we know that if the 8 and 21 cross to the downside, that is a bear market. This is our 4-year cycle playing out. So this was our first 4-year cycle. This was our bear market. This was the second 4-year cycle. That was the bear market. And here's our third 4-year cycle, potential bear market. Now, does it have to go into the bear market? We know the answer to that is no. It does not have to. We do not presume to know what the market will do because anything can change. But we know what the market has done every previous 4-year cycle, and we know that this is right on point with everything. So now if we look at the macro chart here, we can see, which one is this? Okay, so this is just our Bitstamp chart. I may have deleted that's fine. We can just do the quick guy right here. So we can take a look at the worst case scenario for Bitcoin right now. So we know that, and I'm going to just do the simplified version. You can go back and watch my in-depth version for, what could happen, should happen, would happen, etc. But I theoretically speaking, if this is our 5-wave structure playing out right now, theoretically, this is what we're seeing take place. We're seeing Elliott wave 1, and then 2 is the correction, and that's our 4-year. Elliott wave 2, and then the 4 is our correction, and that's our 4-year. And then Elliott wave 5, and now we're waiting to see our correction. And then if we incorporate time cycle analysis into that, wrong one. If we incorporate the time cycle analysis into that, we can go from our top right here at the 1, and then we can just extrapolate that out, and that will give us basically our top based on like our 3 roughly right here. And then that gives us essentially our 1 top, our 3 top, and then potentially our 5 top has already been put in. And that's our 4-year cycle playing out. So if we'll switch this to red. If that's our 4-year cycle tops, and it doesn't have to be an exact science. Sometimes you get a little ahead of it. Sometimes you're a little behind it, etc. Then this will be our bottoms. So we can extrapolate the bottom based on these only a couple data points that we have available to us, but it's better than nothing, better than fundamentals or just guessing. This was our low from the first bear cycle, 4-year cycle. This was the low from our second bear cycle, 4-year cycle. So then we can extrapolate out and see when our low would be potentially for the 5th wave after the correction. And that puts us at roughly January of 2023. So that's a year from now, 11 months to a year from now of just bear market sideways and down price action. So now if we look at each of these, and if you're not familiar with Elliott wave structure, I break it down like very detailed in another video. I highly recommend that you go look at that one. But essentially we're going to look at, what's going on right now and do the quick version. So let me make that a little brighter. So from the bottom right here, or arguably slightly lower, depending on what chart you're looking at. If we go from the bottom right here to the top of the 1 right here, we can see that after we top out, we retrace roughly between the 236 and the 382, right smack in the middle. So we have about like a 30% retracement of the move to the upside. So then if we go from the next bottom right here to the next top right here, and again, just to turn that off so we can see where the peak is at. And we do the exact same thing again. We go from the bottom right here to the top right here. We see that our next bear market took us down exactly to the 382. So the first bear market was between the 236 and the 382. The second bear market was exactly to the 382. So then we could assume with a high level of probability based on what's happened in the past, and that's the only thing we can go off of is what's happened in the past, or just fantasy, whichever one you prefer. I prefer, math and statistics. We would assume that we would get a similar move in this bear market. So if we extrapolate that out and we say, okay, well, it took this amount of time till we got down to the green, this amount of time till we got down to the green, and we went somewhere in between the 236 and the 382 in that green right there, that would, basically give us some sort of useful target. Now, it doesn't have to happen, but we know we went halfway between the 236 and the 382, and we knew it took roughly this amount of time to get there. So where does that put us at? Again, this is January 2023, and that gives us a target of roughly 26,664 to the exact touch of the 382 would be 21,174. We know also that from our previous peak in 1, and then the peak after that in 3, that the 4 did not come back down and touch the 1. And then from the 5 right here peak, we would assume that we would not come down and violate the top of the 3 from our 20,000 high, which would validate that, and that would be fine. Now this is where things get a little crazy though. Okay, I'm going to get rid of this white one real quick. The crazy thing about the Elliott wave 5-wave structure is that after you have your wave 1 and your retracement, which is the 2 of the 1, we then have our wave 3, which then has a retracement of the 4, which is only of the 3, and then we have our 5, and then we have our retracement of the 5, which would be, that target we just laid out. And then we would continue to the upside, right? No, that's not how the Elliott wave 5-wave structure works. Once the 5-wave structure completes, we start off by correcting only the 5th wave, but then after that correction takes place, we put in another lower high, and then we actually correct the entire 5-wave structure. So that's what's here in yellow. So this goes from the bottom here to the top here. So basically from a couple dollars all the way up to $70,000. And then we would expect one of our key Elliott wave retracements to take place. The most common one, or first one for validation, is the 236. The most common one, or most likely one, is the 382. The most bullish one, still staying into like a macro bull market, is the 0.5. And then the last case scenario is the 618. Now, do we get down to the 618? No, I don't think we do. Do we get down to the 0.5? It's possible, but it's going to be real scary. So let's just assume best case scenario, and we only retrace to the 236 of the macro, or let's assume worst case scenario, we retrace to the 382 of the macro. The 236 gives us a target of $6,163 and way out into the future, because if this took us, basically this period from the red to the green is the bear market. From the red to the green is the bear market. From the red to the green is the bear market. This would be the initial bear market, which would be the retracement of the 5. But then after that, we would do something, go into a prolonged, bear market that would essentially make people think Bitcoin's dead, crypto's done, it's crashed, it's never coming back, it was a Ponzi scheme, there's no value, it was a scam, it'll never come back to its all-time highs, get out, everybody gives up on it, nobody pays attention to it, there's central bank digital currencies, people forget about it, and then one day it starts to rise back up. And that's what happens with these 5-wave structures. So maybe it takes a few extra years to play out, but eventually we get down to these macro targets. Now again, it doesn't have to happen like that, but that's typically what happens with these Elliott wave 5-wave structures. So that's what we're paying attention to. Eventually, it's possible that we come down here and we get that $6,000 Bitcoin once again, years into the future. If this was in 2023 in January, this maybe is in 2024, 2025, depending how low we go. But the 236 is about 6,000. The 382 is like $1,400. So does Bitcoin go to $1,400 again? No, that'll never happen. You're mean. You don't know shit. You're dumb. Well, maybe not. We'll have to wait and see. Who knows? Maybe we have a whole bull market worth of bear market instead. And we go through basically that 5-wave structure correction is actually an ABC correction of our 5 waves. So if this is our top right here, this is our top right here, this is our top right here, and then we go basically into an initial pullback to right here, and then we actually overextend past what should be our bottom, and we end up down here at the 236, then we get a push back up and we put in our first lower high ever, and then the market capitulates down. And then, somewhere around, February 2026, we actually bottom out. And then we start going back into our bull market again. Actually, it would probably be something closer to this. It would be our first lower high 4-year cycle, followed by further downside. Again, does it have to happen? No. Is it likely to happen? Who knows? But it happens all the time. I could show you 1,000 assets, 1,000 charts where we do exactly this. And it's not as structured as this because we don't have 4-year cycles built into the actual code. So, and what are the percentages of that? Well, from the top to our first target, that's 68% downside if we make it just to the 21,000 range. If you go to the 236, that's a 91% correction. Again, very unlikely, but possible nonetheless. And then if we go to the 382, that's a 98% correction. So again, does it have to happen like that? No. And now you're like, oh, this dude's so bearish. He hates Bitcoin. He's so mean. I hate this guy. Fuck you. All right, so those people are gone now. Now let's look at the macro of what really happens. After this one corrects, this whole 5-wave structure that we were having take place finishes. And then this ABC correction becomes the 2 of the beginning of another 5-wave macro structure. So we then actually look out into the future and we extrapolate this, and then we end up with that big target, that $250,000 Bitcoin, and then that pulls back, and then we don't come back and violate the $70,000 target, and then we keep going up to the upside here. And that's how we end up with, $1 and $2 and $3 million Bitcoins. Because when we zoom way out here, this whole 5-wave structure that we just drew in is actually the real macro picture. And the 5-wave structure that we're finishing right now is actually just the wave 1. And then the ABC correction is actually just the wave 2. And then the wave 3. And then we keep going from there. So, and then how do we make those targets? Are we just making stuff up? Well, we use a Fibonacci extension target from the top of the 1 to the assumed retrace, which we don't know where that will be yet. But we know that roughly it would be the 1.618 is our typical target. And the 1.618 would be $1 million. Again, do we have to get there? No. Maybe we do, maybe we don't. We'll have to wait and see. So, but yeah, that's it. We're done. That's how you get to crazy valuations to the up and downside based on like actual moves. So let's take a quick little break. I will jump in the chat real quick and talk to anybody that's still left that didn't give up because I made them mad. And then we can go from there. So. Love the river analogy, says Atlas. Hell yeah, man. Mark says, I want to hear the dirty analogies. Bro, just stick around. They're forever endless. A finite resource. Thanks, bro. Wow, that's beautiful, says Mark. Amazing. Bitcoin TA. Thank you, Sunil. Appreciate that, brother. Yeah, so let's take a quick break. Give me about like 2 minutes. I'm going to use the restroom, grab a drink, and then we will continue on. Take a look at the rest of the crypto space, what I'm expecting, Bitcoin dominance chart, total market cap. We'll talk a little bit more about our key levels to the up and downside we're paying attention to. And then we will jump into a little more TA and then probably wrap up around the 2-hour mark. So, and we're at about, hour 18 right now. So plenty to go. I will take some requests if anyone has requests as well when I come back. So let's take a quick break. All right, let's pick it back up. And now remember, if you're just tuning in, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research, trade responsibly. If you want to see the in-depth, long version of what I just did, there is a video on the channel. I can't remember what it's actually called, but it's basically like the most bullish Bitcoin TA or something, how Bitcoin goes to $1 million. I can't remember what it is, but check it out. All right, so we know the key levels we're paying attention to on Bitcoin. We know what we're watching. So the most important areas obviously are close down here and a new low on the daily or weekly time frame. That's going to be huge. We know that we need to pay attention to our potential break back up. Oh, what did I do? I had the drawing tools off before. Okay, so I can talk a little bit about this descending channel as well. So we obviously know we're paying attention to the 200 exponential and simple. So in order for us to break out and back up to get that reversion to the mean play, the retest of the 200 exponential and simple, we know that we need to cross the 821 back to the upside. And then also we have a descending channel going on here. So we have a top right here. We have a top right here. We have a bottom through here, multiple levels. We have a bottom right here. We had a breakout of the bottom, but we were able to like hang on to it. So I'm paying attention to this. And then we see some clear levels along the actual heart line inside of the middle of the channel. You know, you could argue it should be drawn a little bit one way or another, tiny bit this way, tiny bit that way. Doesn't matter. The main point is that we know we're operating inside this channel. And the most likely thing to happen is that we continue to operate inside this channel until we finally break through it, and then we don't operate inside anymore. So we've been in this channel since November of 2021. So we've been in this thing for months. So when we break out, we know we're going to get a powerful move in that direction. We broke down from here. We moved all the way back up to it, tested it as resistance, and then we were able to reclaim it with this massive, you know, this is basically a hammer candle right here. A massive wick to the downside gets bought up and it turns into a green candle, and then we're able to push back up. So what could happen right here in a bullish scenario is we push back up here, we get on top of the 8, we consolidate, we get on top of the 21, we consolidate at the top of the range right around like 40,000. Eventually the 8 and 21 cross to the upside, and then we get our measured move breakout of the channel, which is from the bottom of the channel to the top of the channel, and then that measured move gives us roughly the breakout of the actual channel itself, which will likely take us back up to the 200 exponential and simple almost perfectly, depending when it happens, you know, because obviously these are going to keep creeping down. And that's our reversion to the mean play. And, you know, we're in a clear downtrend. We get a push back to the upside. That's a relief rally of the downtrend. And then we would expect that most likely what will happen is we will see continuation to the downside after that. It's possible we reclaim those levels. We start moving back to the upside, start reclaiming key levels, get back on top of the 200 exponential and simple, and then go back into a bull market, and all this is invalidated. Totally a possibility. And it's important that we understand that no matter how good our TA is, how likely something is, the probability of it, that the opposite can always happen. And by evaluating that and knowing what key levels are, we can know when we can say, okay, I was wrong, time to go bullish. Or, okay, I was right, time to go bearish, or whatever, you know. That's the most important thing. So that's what we're paying attention to. We have the channel. We have key levels to the up and downside that we're paying attention to. We have potential for bullish divergence on the daily. We have potential for, well, we have some bullish divergence already on the daily. We have potential for some bullish divergence on the weekly as well. But we have very clearly bearish divergence already playing out on the weekly and potentially monthly as well. So that is it for Bitcoin. Let's go on to Ethereum. So we know Ethereum, I think I deleted this chart. I was getting fed up with my long-term charts just being too nasty. So let's just real quick, we will draw a quick Ethereum chart. So we obviously know that we basically put in a double bottom right here on Ethereum. And then from that point in time, we were moving to the upside pretty aggressively. So I like to skip like the little wick pushes at the end because they're usually like capitulation wicks or blow off tops. And then I go from like actual closes on longer time frames. So I had this drawn in basically. Initially, we had drawn it something like this. And then we broke down from it. This is how it initially was drawn. And then we actually broke down below it. And then I started actually to like the amount of touch points that we had right here. So we kind of adapted to it. And then eventually, you know, we just kept extending this out, extending it out, extending it out, extending it out. And then eventually we end up with basically this was our channel that we were operating inside of forever. So then we're paying attention to where's the top of the channel. Well, this is what I ended up with for basically the entire bull run up. So we had a very clear support at the bottom right here in white. We had a very clear resistance here in white. And then we had a blow off top, or, you know, throw over or failed breakout, came back down. Well, why did I decide this isn't part of the channel and it's outside the channel? Because I like the heart line. The heart line is perfect here. It's perfect here. It's perfect through here. Through here, we're finding support, support, support. Here it's acting as resistance, resistance. So this is how it should be drawn, in my opinion, because that's how the bots, the algos, the market makers are drawing it. So I don't care what's right. I don't care what's wrong. What I care about is the people that are making these markets, that are moving this price action. I care how they're using these tools. I don't care about being right or being wrong. I will adapt to the situation if I need to be, because I don't care. I'm not big enough to move any of these markets. I need them to do it. And all I'm doing, I'm just picking up breadcrumbs, translating the messages they leave on the chart, and then just following along. So we know at that point in time, when we broke down from this key support right here, and we were unable to reclaim those levels, that we were going to have a capitulation move. So we obviously exited our Ethereum position. I believe it was like right in here at like the breakdown. And then at that point in time, it was basically capitulation city after that. So once we broke down below the 200 exponential and simple, eventually we expect a move back up to retest the 200 exponential and simple, that same reversion to the mean play. Now, we do not have that clear-cut channel the same way that we have on Bitcoin, because what we were using as a channel got just absolutely decimated, because we basically had something like this initially. You know, we basically had coming back to here, resistance, resistance, support, support, support. And then once we capitulated from that, we then came back up, couldn't reclaim that level. And this is that move we were talking about, where we have now the channel resistance was support, now it's resistance, lining up perfectly with both our 200 exponential and simple right here. And it's almost impossible to get back through that, because we have three very, very strong lines. And then also we had the 21 in the same spot. So it was nearly impossible to try to get back through that. So then we had a capitulation move from there. So now we don't really have like that same channel how we did on Bitcoin. So the alternative to this, because that's no longer, you know, a valid method of charting, because we don't really have anything there, is, you know, basically the acceleration. So we can go from the top right here, and we see we have very clearly 2 points right here, and then we start to go into an acceleration to the downside. So now we can take one and put it at our next point right there, and then we can draw it from our next one, and we see we start accelerating from that point in time to the downside, and we're essentially creating a parabola. So we have 2 points right here, and then we're not even coming close to that one. And then we have the next point, next point, next point, and then, you know, a wick up here, and we're not even getting close to it. So now we can draw a third one, and we can go from this next point right here to this point right there, and then we continue down, and now that is our third line of the parabola, and that's the only real valid, you know, resistance line that we have. So the resistance line of the parabola now is from this point to this point, and then we see pretty clear interaction here, and then a wick right there, and now we're almost at that point again. So Ethereum is all but at resistance of our third line of the parabolic resistance, as I like to refer to it. So, you know, and you're not going to see this one as like super technical, whatever. It works both ways, on the way up and the way down. It's basically just talking about the acceleration of the trend. So, you know, and the idea behind that being, when you have a topping pattern taking place, you're still in a bull market here because you have a higher high. And then you start to roll over and you start putting in lower highs, and then lower high and lower high, and then it's accelerating. And then eventually you get to a point where it can't accelerate anymore. It's basically just going straight down, and you have your capitulation, and ideally some kind of divergence takes place, at which point in time you break out of that. And then, you know, that would give us essentially the same as that Bitcoin measure move in the channel that we were talking about before. Say we broke through this parabola here, cross the 821 back to the upside, and get that push back up. Well, it would be our reversion to the mean 200 exponential and simple, and give us a target on Ethereum at roughly like 34,000. So that's what we'd be paying attention for our next potential, you know, bullish move to the upside. Now we could very easily, and more likely than not, we will probably do the same thing again. Because look, we had an opportunity here, resistance, resistance. This was our chance to break through. But what happened? Well, we had this resistance in yellow, and then we had the 200 exponential and simple Couldn't get through it. It was just too much for us. So we couldn't get the push up there. So now maybe we get it this time, or maybe we just capitulate and put in a new low. We'll have to wait and see. The key area we'll be looking for on Ethereum, and the area we do not want to validate under any circumstance on Ethereum, is 1793. So call it 1800. So the key level we want to pay attention to is 1800. We do not want to validate 1800 because obviously that was resistance, resistance, support, support, support. And then if we go over to our weekly, we can look at our moving averages here. So we see on the weekly moving averages, we obviously been in a bull market for a long time. We now have crossed the 8 and 21 to the downside for the first time since we got bullish in April of 2020. So we're now officially in a bear market on the weekly. We have crossed 821 to the downside. Well, I shouldn't say officially in a bear market, but officially in a bear trend, something like that. So essentially what we're paying attention to is a pushback up for a lower high and then continuation reversion to the mean. So the same way when we're under the 200 exponential, the reversion to the mean is the pushback up to it and then continuation to the downside. On the macro weekly, the reversion to the mean is just a pushback down to the 200, find support, and then move back to the upside. So while you could say, oh, you're just being bearish, I'm like, am I being bearish or am I being bullish? But we have a short-term bearish perspective based on what the market's doing, because that's really what's going on. Because the real target is the 200 exponential or 200 simple, which is Ethereum like 1450 or 1000. And then after that, the target to the upside is much higher, assuming we hold support, come back up, and start putting in a new high. But the next play for us is obviously a short off the 200 exponential on the daily, or a long off the area that we're at right now if we cross 821 back to the upside. And then the play after that is, obviously we bounce the 200 exponential and simple, and then it's a long from that point in time. And then we see where we run into resistance at again, probably assuming we get all the way back down there, probably around like 1850 or something. And then we, just play with the trend. Just keep letting the market lay out the plays for us. We're not looking for the trade that we want. We're looking for the market to tell us the trade that it wants us to take. We're looking for it to give us the opportunity and then for us to exploit that opportunity. All right, so let's look at our Bitcoin dominance chart. So Bitcoin dominance chart, we've been paying attention to this. Once again, we're looking at that divergence taking place. We have a low with the red arrow here. We have a lower low with the red arrow here. And then we have a series of lower lows once again. With the red arrow right here, it's a little easier to see on the weekly. So we have 1, 2, 3 drives of, depending where you want to put that, that's really where it should be. 1, 2, 3 drives of divergence, or three lower lows right here. And then if we look at our indicator oscillator, we have 1, 2, 3. Each one is higher than the previous. And then again, not as clear on the TJD Jewel Thief. So we have very clear bullish divergence here at this green support line. So this support line is going down while the histogram is going up if we drew a line from each of the histogram points. So that's triple weekly bullish divergence, which gave us that bounce off here and told us that we were topping out on Bitcoin. We were expecting everything to sell off and Bitcoin to gain market cap in comparison to the shitcoins or the alts or whatever. So at this point in time, it looks to me like what has happened is we had a 1, a 2, a 3, a 4, a 5, and then we went into an A, a B, a C correction. And now it looks like the C correction has bottomed right here. We have put in our low, at least for now. We'll have to wait and see. At which point in time, we would expect this to start marching back to the upside. And we know that this low right here was the 2018 top for alts. And then this was the bear market. And now it looks like we've put in a bottom again. So we would expect once again a similar move like this. We can't perfectly extrapolate this out, but let's just say, for instance, if we did, roughly something like this off of a bottom, this would give us essentially, and again, this is sort of a fractal, which is the least reliable way to do things. But assuming we basically broke out of our channel right here, this would be the measured move. And then that would be the 1, which would be the reversion to the mean of the 200 exponential and simple, which we would expect to act as resistance. Then we break back down. And then what was resistance right here, we would expect to act as support as we reclaim that level. And then continuation, chop around the 200 exponential and simple, eventually break through, put in a third, a lower high right here, come back, retrace, and then by then the 200 exponential and simple are starting to roll back to the upside. Then we find support on those levels, and then we see continuation to the upside, at which point in time we put in our 5, and then we begin the cycle all over again. We have a 5-way structure back to the downside. So, and then we would assume that this would line up with our 4-year cycles playing out, roughly. But again, the further into the future we go and we try to extrapolate these moves, the less reliable they are. So right now, we're just focused on what's happening right here in this little thing. We're not focused on, what potentially will be happening in 2023. But so far, it's been playing out perfectly. So that's what we're paying attention to. And then crypto total market cap on the weekly. So the same way we saw that top out on Bitcoin, we have a high right here and a lower high here. We have a high right here and a higher high here. Same on the Jewel Thief as well. We see bearish divergence on the weekly. And then a breakdown, we see the 821 cross. Last time we saved the cross and it was all good. Here, we don't know what's going to happen yet. But if we take out this low right here at $1.28 trillion in crypto market cap, we know we're probably going to, we'll have put in a lower low. We'll probably retest the 200 exponential or simple, which is going to give us a total crypto market cap of $978 billion. Or if we go to 200 simple, roughly like $750 billion. And what would that mean? It will mean most of the altcoins will not exist anymore. And, Bitcoin's market cap will be substantially less. So, and then as far as extrapolating with our Fibonacci extension targets, well, we can see here, this is how we called out the top perfectly on crypto market cap and Bitcoin at 60,000. We basically put in an Elliott wave Fibonacci extension from our target right here in crypto total market cap of 758,000. And then we took that tool and we put our low in. And again, the only reason I have it extended out right here is so we can see the target. But this is essentially what we did. We just went from the high right here to the low right here, and then it extrapolates our 1.236, 1.382, 1.5, 1.618, 2.5, 2.618, all those targets into the future to give us potential Fibonacci extensions, which is an external, target outside of the previous high. So now that gave us our 1.618 Fibonacci extension target. And you guys know when we got up right here and we almost hit the 1.618 on that initial top, I told you guys, yeah, we got really close. And I'm happy that we got that close to the 1.618, but we didn't get there. And I know that algorithms, market makers, bots, trading, whales, whatever, don't like to get that close to a target without hitting it. They like to hit it or overshoot it slightly. So when we didn't get to it, that made me even more bullish on what turned out to be triple bearish divergence, triple bullish divergence, and then a new high. And then we actually made it exactly. We actually made it exactly into my red box right here. We put in our bearish divergence on the weekly. We tagged the 1.618 Fibonacci extension target. The exact same thing we did on Bitcoin. We did on the total crypto market cap. And then at which point in time we broke down. So now we're paying attention to the macro targets and what could happen into the future. But we don't presume to know what's going to happen, but we know what's likely to happen based on probabilities and what has happened previously. So PayPal, we saw the capitulation dump today based on the earnings. MicroStrategy reported as well. MicroStrategy's earnings are fake because they're not an actual company. But look, estimated earnings were going to be 89 cents, and instead they were minus $8.43. Part of that is because of how they have to report Bitcoin on their balance sheet, because basically if it ever closes or trades at a price lower than what they bought it at, they have to mark down. So essentially they had a miss of 1,047%. But let's be real. We all know Michael Saylor is a scammer and this is all fake anyway. So, but the surprise was 1.31 million in earnings. But the surprise in in revenue, but the surprise in actual earnings was 1,047% miss. And we also know that if you would have bought Bitcoin instead of MicroStrategy, you would not be down nearly as much because MicroStrategy is down 74% from its high and Bitcoin is not even down, I think, 50% from its high. So MicroStrategy is literally just a worse way to own Bitcoin. And then you have counterparty risk, which is Michael Saylor being a scammer, and obviously him being a shady bum piece of shit. Oh, sorry, I don't know why I use that tool. But we know that Bitcoin is down from its high 46%. So if you bought MicroStrategy and said, I'll just own MicroStrategy instead of Bitcoin because Michael Saylor's great, you're down twice as much. So you have a leveraged play on being a loser if you invested in Michael Saylor MicroStrategy instead of just buying Bitcoin. So, but I know none of you guys are dumbasses, so you would never do that. So let's look at our, what do we want to look at? We'll look at our commodity markets here. And what are we at time-wise? Hour and 41 minutes, so okay. So gold's still chopping around, trying to reclaim the 200 exponential and simple. Nothing has really changed right here. We got the monthly close. Did we look at the monthly since it closed? I don't think we did. We got the monthly close, exactly what we're saying, right at the 821. These are just tightening up right here. So we obviously see a bunch of red histograms. We have broken down below the blue slope line. That is not good. When that happens, typically, we then go into a multi-year bear market the same way we did right here from our 2011 top. And then we actually technically bottomed in 2016. But I honestly did not get bullish on gold until June of 2019 because we took out finally this top right here, that top right there, and that top right there, which was perfect because we were able to capitalize on the move to the upside and not just have dead money and losses forever. So this does not look great to me. Starting to show a little bit of life. What this reminds me of right here, though, when we see these Stochs curling up like this, it reminds me of this right here. Stochs are going to curl back up and then get rejected and then continue to the downside. And what does that look like on price action? Well, it looks like exactly what's happening right now. The moving averages are tightening. We're trying to push back to the upside, trying to save the trend, and then we're going to go into a bear market. So what does that mean? No, because the fake money and because the gold and the central banks and I don't know. I don't know what's going to happen. I don't know what the news articles are going to say. I can't speak to any of that. Should you own some gold? Sure. It's not financial advice, but I own gold. I own silver, but I'm also diversified. So should you diversify? Probably. Silver, definitely don't join a cult. Don't join the crypto cult. Don't join the silver cult. Don't join the Tesla cult. Don't join an actual cult. What are those people called with Tom Cruise? Just stay away from cults in general. You know what? I'm not going to give you any financial advice, guys, but if I can give you some life advice, it's just don't join cults in general, no matter what they are. Just not a good idea. So, unless it's like a good kind of cult where it's like, oh, we're a cult that helps underprivileged youths. Oh, okay, that's cool. You do that, sure, go ahead. That's okay, but also careful of culty behavior, even doing that, because there's probably something weird going on. Anyway, so XAG, so our silver chart looks terrible. We're under the 200 exponential and simple. We got rejected the first time. We got rejected again in the lower area. So we have a high right here. We have a lower 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 high right here. All we're doing is just consistently putting in lower highs. We have broken down from our horizontal channel that we're operating inside of forever. We're barely at the bottom of it, trying to reclaim it, and it's not going well. Eventually, we broke down from it a couple times and reclaimed it. If we break down from it again, silver's going to be in the teens. It's going to go to 19, 18, 17. Count it down with me. 5, 4, 3, 2. All right, maybe not that low. Maybe not that low. But it doesn't look good. If your investment group is named after a primate or something like that, primate like orangutans or the monkeys or the apes or the silverbacks, it's probably not a good group to be in. I'm just saying, don't join a monkey cult. And that again, just don't join cults in general. You know what? I'm sticking to that. URA, uranium. Okay, so we've been massively bullish on uranium for a while, but we're not anymore. We're done. It's finished for now. I'm still massively bullish long term on uranium into the future. But in general, uranium and energy in general, they had a great run. Commodities had a great run. Let's not get greedy. We lock in our profits and we're just going to relax for a little bit. We have broken down now below the 200 exponential and simple. 200 exponential is rolling over. 200 simple has a flat slope. We're getting the reversion to the mean play right now. We're assuming this is going to reject us right here. If we reclaim these levels, start consolidating, maybe we get bullish again. Right now, it looks like we're going to get rejected and roll over and put in new lows. So we can look from our bottom to our top, assuming the macro play has played out. And, we can obviously look at our Fibonacci's based on that. But we're looking to be a buyer at a lower price down in here. And then once again, we can see what that divergence looks like when it plays out in real time, as we had this wedge forming and we had a high, we had a higher high, we had a third higher high, and here we had a high, we had a lower high, we had a third lower high. We had a high, we had a lower high, we had a third lower high. And the only reason this may seem redundant, because I constantly show you guys the same things over and over, and you're like, oh, more bearish divergence, geez. Because look what happens afterwards. So we don't get caught by surprise, because the market makers, they leave us those clues, those breadcrumbs, you know what I'm saying? And all we got to do is just pick them up. We just look at them, we do that little forensic work on the breadcrumbs, and we're like, oh, it's one of the 3 blind mice. We got them. But if we do look at the longer time frames, though, we'll see why I'm still massively, massively bullish on uranium in general, because this is our weekly chart. Uranium has been getting absolutely rectally destroyed, and not the good kind, for, basically like decades. This was our 2011 top right here, and then we finally rolled back on top of the 200 exponential and simple for the first time. This was our initial push up, and then this was our third one. Arguably, once again, we're looking at a potential Fibonacci. And again, just not to be like too overly redundant, but 1 push, 2 is a retracement, 3 push, 4 is a retracement, 5 push, and then now what are we doing? Well, potentially an ABC correction pattern. So that's why we have our, Elliott wave and Fibonacci extensions or Fibonacci retracements are like some of the most accurate predictors. So we have from the bottom here to the top here in orange. So we'd expect our initial move down here to be at least to the 236, possibly lower to the 382, and then some kind of push back up, which is like a relief rally, and then possibly a push down lower again. Maybe we don't get that low. Maybe it's already taking place right here, and that was our B, and then this is our C, is to the 382. I'm okay with any of that. That's completely fine. I'm completely fine taking positions off the 382 or the 0.5, but if we zoom out on the macro and we really look at it from the top to the bottom right here, we see that we actually just bounced perfectly back up to 50%. So we came all the way down here. We had a relief rally of a 50% move back to the upside. And now the most likely thing to do is to touch the yellow 382 and then see what happens there, or possibly the 236. So these are my targets. We have obviously already touched the yellow 382 and 236, so we invalidated that. So the most likely target is to take a position somewhere around like $14 to $17 for a macro uptrend, because now we have flipped the 200 exponential and simple bullish on the weekly time frame. So, and then if we go to, I don't think we really get anything off the monthly on this. We see we have the 821 flip to the upside, finding support temporarily, hard sell signal, multiple red histograms. So more likely than not, we do see continued downside pressure. But it looks like at this point in time, we've completed the first 5-wave structure. And the same way that we did that 5-wave inside of a 5-wave on Bitcoin, we could look at this as the wave 1, and then this is our wave 2 correction. And then we get after that a wave 3, something like that. And then again, a wave 4, and then something like this, a wave 5, possibly back to all-time highs, possibly to new highs. And it's like, yeah, how do you pick these targets? You're just making stuff up. Well, we take from the high right here to our low right here, assuming we have a shallow correction, and then we go to the 1.618 or the 2.618. That would give us a top at like $44, or up here at the 2.618, which is where we just had it. Or if we get a more deep correction to the 236, that would give us a retracement back down to 1350. And then we would expect somewhere around the 1.618 or possibly as high as the 2.618. And then again, we just start looking at our corrections. So, and then we can just extrapolate from there as we go. But we have to wait, because obviously it can vary a lot based on, what happens in time. So, so that is uranium and what we expect in the space. And, everybody's super bullish on uranium right now. And we're gone. We were there at the beginning. We already flew to the destination. We had fun on vacation. And then we went to the airport. And then we have all our bags. And we're like, oh, man, we need somebody to carry all these bags for us. And then everybody else shows up. And they're like, uranium's so great. It's bullish. Nuclear power. And we're like, yeah. Here, hold these bags for us. And then we go back home. And then one day we'll come back on vacation. And when we show up to Hawaii, they will be waiting there with our bags still. The bags will be absolutely crushed. They'll be worth a fraction of what they were worth when we gave them to this person, and they would be like, please take these bags back, and we'll be like, okay, bro, sorry you got wrecked, and then we'll take back the bags, and then all of a sudden uranium will go back into a bull market, and we'll do that all over again, because that's how we get in front of all these trends and leave all these suckers holding the bag. And they're not, it's not that they're suckers. Well, I mean, they are, but we're not suckering them. They're just dumbasses. They don't listen, because we do this. All they have to do is listen. They just join the team. But instead, they are our butlers, our maids, our gardeners, whatever you want to call them. So lumber obviously went parabolic, had a pretty deep retracement. I'm not sure what I still have drawn on here. Okay, perfect. So we had a pretty deep retracement from the bottom to the top of our Fibonacci. We came down below the 618, came down almost to the 786, but not quite. And then we had from the top to the bottom, our Fibonacci here in yellow. We had initially a pushback up to the 382, back to the 236. Then we came all the way up to the 618, then found support. Then we pushed up one more time to the 786. So from the top to the bottom, we had a 78.6% retracement of the move down. So we went all the way down, then we came back up 78.6% of that move down, and now we're pushing back down. So we busted through the 618 after multiple gap downs on the lumber after the new contract. And now here we are at the 0.5, which is a 1-2 fib level bounce back down to the downside. So now this is an inflection point, because more likely than not, well, we know one of two things is going to happen. We don't know which one is going to happen. So we either bounce this 0.5 and then we come back up here and put in new highs, at least to the 886, or we eventually, maybe we push back up to 618 and then get rejected, and then we go lower, which would take us down to likely the 382. Either of these is still potentially bullish, because the most important thing is that we have a low, then we have a higher low, and then, obviously just a series of higher lows. But something like this is essentially what we're paying attention to. So lumber could go either way to me right now, but we have reclaimed the 200 exponential and simple, which lines up perfectly with our Fibonacci. So more likely than not, based on where our indicator oscillators are, I think we bounce this level and then we try to push up higher. If we take out this high right here, we probably go to new all-time highs. If we come back up here and put in a lower high, then we'll be looking for that key support level to see, does this green line get invalidated? And then we break back down below 200 exponential and simple. And then we, that's, if that happens, it's not good for the economy. Not good for the economy, because it probably means no one's building stuff or, playing with wood. And that's not good for, like, housing or just economic activity or GDP in general. So let's look at the dollar really quick, and then we'll probably call it there. I will jump in the chat here. Yeah, we're at 154, so getting close to time. So DXY, nothing has really changed here. So we're getting the pullback that we talked about, as expected. I told you that this thing was pretty high up here. We put in some very clear divergence playing out. So we have a high, we have a higher high, we have a high right here, we have a lower high, we have a high, we have a lower high, we have multiple red histograms. We never flip the slope back over. This is good. This is what we want to see. We want to give people that have dollar denominated debt an opportunity to get out of their positions. We do not want to just see this thing go parabolic, because it is bad for the world. It is bad for the world economy if the dollar just continues to go parabolic. This has been a counter trend rally that has absolutely destroyed many people that have dollar denominated debt that do not get paid in dollars. So foreign currencies, or people that have currency risk, they took out debt in dollars, assuming that the 40-year downtrend would continue, but they were wrong. And then if we go to the weekly chart, we see here, once again, we're just following the trend. The trend was down for multiple years here, as we were below the 200 exponential and simple with a negative slope. Now we have reclaimed the 200 exponential and simple with a positive slope. We saw 1, 2, 3 drives of bullish divergence, 1, 2, 3 drives of bullish divergence, broke out, double bottom, measured move, breakout to the upside. And I'm not going to turn on the drawing tools because it gets a little wild. But now we're seeing that hard sell signal, finding support at key levels, 200 exponential and simple, selling off pretty aggressively. Okay, nothing to be worried about yet. If we start coming down here and we break below like 95 and start closing below there on like a weekly, then maybe we'll pay attention. But I think more likely than not, we probably just chop around sideways here for a little while and then eventually end up in a pretty aggressive macro uptrend. And then if we look at the monthly, we see once again the most important trend in all of existence, the always downtrend on the dollar. We have a high, a low, a lower high, a lower low. And then here we came all the way up here. Reclaimed the 200 exponential and simple on the monthly. We now have them angled to the upside. The 8 and 21 have crossed to the upside. Hard buy signal coming out of the bearish control zone. We're inside the bullish control zone. Stochs are powerfully angled to the upside. We have the Stoch histogram on the TJD, TDMACD, multiple green histograms. We have crossed over the zero line. We have flipped the slope back over blue right here as well. So typically when that takes place from the initial flip or somewhere around there, you know, we have basically like 5 to 10 year periods of bullishness. And this is the first time we have ever flipped the 200 exponential and simple bullish since essentially this pushback up here in roughly like 99. And we know that one lasted like multiple years and was a massive, massive squeeze to the upside. So we will have to see how that plays out. But I think that is going to do it for today. I will jump over in the comments real quick and then we will call it there. All right, guys are quiet now. Active in the beginning, but hey, nothing wrong with that. So yeah, appreciate everybody tuning in today. Thank you all for your support, for your interacting in the chat. Hopefully y'all enjoyed the stream, the content, the technical analysis, all that good stuff. You guys know that I stream every Wednesday and Sunday from 8 p.m. Eastern Standard Time to roughly 10 p.m. Eastern Standard Time. What was I going to say? Oh, and yeah, if you have any requests or anything like that, you can put them down in the comments or in chat, and I'm glad to look at those for you. If you have any interest in the indicators, they are all free except for the TJD Master and the most recent iteration of the Jewel Thief. If you have any interest in those specifically, all you have to do is make a one-time contribution to the channel, to me, for my hard work, and you can join our exclusive, limited time only members fucking awesomeness of awesome Discord, where we just talk about random stuff and trading things, and also you get access to the sweet indicators as well. So but yeah, that's it for today. That's it for in general, and we'll see you on Sunday. Be careful, protect your principal, protect your capital, all that good stuff. Careful out there. These markets are very close to confirming some craziness. We're obviously seeing random gap downs of 20 and 25%, and you do not want to get caught by one of those, like some Kevin Leary little bitch who literally was on CNBC talking about how I'm buying Meta because the metaverse, and I'm a beta male and things are great and I'm smart and the sharks are with me because we're great. And then 15 minutes later, it gaps down 25% and he looks like a little cucked bitch. So, yep, that's it for today. Hopefully you guys enjoyed the stream. And, yeah, that's it. Crypto Trend Trader with our Wednesday midweek market update. I will catch you guys on the flip side. Good to see you, Quentin. Appreciate you, brother. Everybody have a good night. And, yeah, that's it for today. Make sure you check out those free videos on the channel. Learn how to use the indicators. And, yeah, that's it. So it is February 2nd, 2022. This is our Wednesday midweek market update. It is 10 p.m. Eastern Standard Time. And I'm out of here. Peace.